First, on the storm, as I'm calling it, how bad is the storm, do you think, economically?
The storm is choppy, but it hasn't really changed much in our view, right? I think going into now the latter half of the year, we still see volatility ahead, but the fundamentals are strong in that you're seeing consumer household balance sheets are really good, the labor market. So we're not really forecasting a prolonged downturn or recession. That being said, I think our view is the same it was back in 2019, right? We've been telling our clients, be prepared for lower returns in the previous decade, be prepared for more volatility. And by the way, inflation, while you haven't seen it for a long time, it may show up. And here it is in our shores, right? So for us, it's about staying invested, staying disciplined, maybe more defensive today, but always diversification, right? It's not just about stocks and bonds. Now it's about alternatives. How do you get more outcomes and solutions? Because there's really nowhere to hide in a world where all correlations go to one.
Well, let's talk about that exactly. As we have a Federal Reserve and other central banks raising rates, and it looks like they're going to continue doing that for a while, it necessarily takes asset values down, whether it's stocks or it's bonds. And we're seeing that, goodness knows, in the markets overall right now. What do you do if you're an investor in that world? Are there some assets that are better than other assets?
Well, look, one, I would say this is where active management, I think, comes back into the fold, right? So there's going to be winners and losers. Clearly, in today's environment, we see buying opportunities. You have to be careful of value traps as well. But then you think about inflation, rising rates. Well, if you look at middle market bank loans, senior loans, well, they have floating rate paper. You think about getting more exposure to commodities, things that have a higher correlation to inflation as well. Real estate. These are all the different mixes. That's why when I talk about diversification, it's like there's active management, but there's also, you can be more explicit and intentful to ride the wave with, benefit from rising rates, to actually be highly correlated to inflation in an inflationary environment.
In active management, you're going to have exceptions to any rule, so you have to be careful. But as a rule, is it a time to stay away from equities because that discount rate is going up and that automatically just reduces the value of the equities?
I would never say it's time to stay away from equities. Obviously, when we believe in staying invested. That being said, today on the margins, we see more value on the fixed income side versus credit. We see more value actually in high yield, right? You've got a high yield market almost topping 8% in yields. Maybe again more active management there, picking the better credits, stronger credits. So yeah, on average we see a tilt more towards fixed income, a tilt more towards private markets. But I would never say completely stay away from equities.
So talk about high yields, because I've heard others suggest that's sort of almost a substitute for equities in a way. And obviously we're getting some bigger returns now. But we're getting bigger returns for a reason. As we're worried about a recession, a downturn, you're worried about some of those companies not being able to pay back the money.
And by the way, we acknowledge that actually spreads can continue to widen from here. That being said, when you look at a risk-return perspective, you look at some of the most attractive pricing we've seen in quite a long time. These are still the areas where, again, active management, picking the right credits, maybe still being more defensive, picking the stronger credits, but the yield versus the risk that we're taking and the pricing you're seeing in equities versus the high yield in the fixed income market, today we see more opportunities there. But look, this is, we're in year 3 of this kind of quote unquote interesting and challenging year. Guess what? I think 2023 is going to be more of the same of that. You're going to have volatility. Now is the time to, again, stick to your discipline, stick to a diversified portfolio, but then again, actively, you can find these pockets where you can do well.
In that diversified portfolio, you think it's time to take another look at municipal bonds?
Oh, I do. I mean, munis, if you think about it, right, they've had a pretty rough year in terms of redemptions out there, yet from a credit profile, they're stronger than they were last year. They're better from a yield perspective. I think that's a market that's kind of looking at Fed policy and where rates are going to settle. But today, munis are looking very attractive, and I think you're going to see a lot more flows going into the muni market.
But even within munis, though, do you have to have some discretion, some active management, which munis you're buying?
Absolutely. We've shown that over the years, whether it's decisions to be in Puerto Rico, not Puerto Rico. Not all municipalities are created alike. And again, that goes back to, in an environment like this, again, active management is going to be a bigger trend than it's been in the last decade.
Jose, you mentioned alternatives, particularly real estate. What are you looking at right now in real estate?
Well, the markets that are extremely strong in real estate for us today would be the industrial market, things like warehousing, logistics. Multifamily housing is very strong. Retail, amazingly, it's come back significantly. We've seen more openings and closings here in the U.S. Office market is, again, still a little bit lagging there. But again, there's an example of we focus around diversifying our own real estate portfolio, and you're able to pivot quicker into these different themes.
Last time you were on Wall Street Week, we were talking about agricultural real estate.
Yeah.
Has that picture changed since we last talked?
Well, imagine this, right? It's just become so much more attractive, right? When we look at an asset class like farmland, and there's others that we look at it that way, we talk about an 8% return, you're clipping a 4% coupon. It's pretty boring. Well, in this environment, and by the way, a hedge, highly correlated to inflation. These are the asset classes where I think historically people understood it academically, but hey, you know what? The S&P is going up 15, 20%. It's kind of a hard trade-off. Today, I think these are the asset classes that make a lot of sense, whether it's the real estate sub-asset classes I talked about, whether it's timber, whether it's renewable infrastructure. Now that alpha is real because you're smoothing out your returns and you're having a higher yield component and one that's highly correlated to inflation.
Put all this discussion over against demographics for a minute. We're in National Hispanic Heritage Month. I'm very mindful of that. How does this work differently, perhaps, for some Hispanics?
Well, it works very differently, and a lot of it is about inclusion. What's amazing to me is you look, the Hispanic population is the largest minority population in the U.S. It is the fastest growing population in the U.S. If you think about the GDP that it generates, if it was a standalone country, it would be the 7th largest GDP in the world. So one, tremendous buying power by this population, right? So I think there's a business opportunity here. But what's amazing within that demographic, less than a third of the Hispanic population has access to retirement services or advice. And again, in times like this, I think that hurts that community even more. So again, I think we have to kind of reach out from an inclusivity perspective, but I often tell my peers in my own firm is it's also a massive opportunity. Again, a lot of buying power, highly underpenetrated in advice and in retirement products. I think it's just a huge opportunity.
So what lies behind that great disparity about access to retirement advice, investment advice? Is it the nature of the jobs people have, so they're working in positions that they don't naturally come to it? Is it because we don't have the financial institutions in their areas, in their communities?
There's two things. One is financial literacy, right? And then just kind of really engaging that community and driving higher financial literacy. The other one is just pure diversity and inclusion, right? I remember starting out my career looking at marketing materials that were all driven in Spanish because there was more clients and customers that just spoke Spanish. And I read it and I'm like, well, this translates really well, but my mom would be pretty insulted by this. And you're like, how does that happen at a large company they probably paid a lot of money to an agency? Well, there's no one sure there were people in the room that can translate to Spanish, but there was no one in the room that really kind of understood that journey, understood that culture. And I think to me, that's also what's missing. As we get more inclusion and diversity, we're able to better access these markets. And that's why I've always said this is a bottom line issue at the end of the day. There's a lot of money firms are leaving at the table by not engaging that community better.
Yeah, it helps to have somebody at the table who understands that community.
Exactly.